Well, I have a strongly positive view on European equities versus US equities. That's one thing, and that has quite a few reasons. That's not only the, I think, more effective handling of the COVID crisis, but it's also the EU Next Generation Agreement, which puts measures and structural measures in place to deal with upcoming challenges in a much, much better way. And the euro-dollar development has anticipated and shown this here the last few weeks. However, one thing is very important to note: this is a relative statement. There's no way the global equity markets would rise if let's say, if the US market, for example, would decline, which I don't expect. The US market has led, and therefore it's a normal thing in terms of valuation of comparative developments, that there is some geographic and some sector rotation, but some sectors like the US technology sector will continue to do very well, and there's nothing comparable here, of course, in Europe.
Yeah, slightly concerning to me was the disconnect that we saw in European markets in July versus US markets. And, you know, in the recovery phase on the back of the March numbers, as we saw a spike in stock markets, a number of the European markets tried to catch up with the US peers, and the DAX has certainly had a fairly stellar effort. But a lot of that started to just fall away in the month of July, even with talk about this European Recovery Fund. Why was that? And does that highlight anything to investors that they need to be concerned about?
I don't think so. I think there is a big dispersion between geographies, countries, and sectors, and that's COVID news dependent. So therefore, I think that European equities, in terms of valuations of policy support, are very well positioned. But of course, if you go then one notch below, you will see big distortion of performances, as you have seen that in the US market. And then last but not least, now it's August, we had a V-shaped recovery in global equity markets, anticipating unlimited liquidity and some sort of economic recovery. But, you know, September, October are seasonally weak months in terms of equity market performance. And then, of course, the news flow in general. One thing is the US election and geopolitical frictions is going to heat up as well. So lots of room for active managers to prove their abilities. And I would certainly advocate a barbell strategy, to be exposed on one side to equities, quality companies, and on the other side keep a healthy proportion in cash, in order to be on the safe side, and most importantly also to be able to tap opportunities which will come up in the second half of the year.